I welcome everyone to the third Dr. Verghese Kurien Memorial Lecture today. I take this opportunity to welcome our distinguished guest, Professor Raghuram Rajan, who is popular not only among the corporates and financial world, but also among the common people. And it is evidenced by the packed house that we have today here. So, we also received an overwhelming response to the event, and hence the lecture is also being webcast today so for those who are unable to attend the event. Sir, it is an honor to have you with us here today. I also extend a warm welcome to all the dignitaries and our audience here. And before proceeding further, I once again request the audience, if you have not turned off your mobile phones, to kindly do the same. And I request the audience to please jot down your questions if you have any. We have our volunteers in the aisle, so you could pass on your chits to them, because we will be having a question and answer session right after the speech by the chief guest. May I now invite Director IRMA and Chairman IRMA to please come on stage. Without any further delay, I invite our chief guest, Governor RBI, to please come on dais. Thank you, sir. I would now request the director to present a bouquet to our chief guest. May I please request the chairman to welcome our eminent guest. To mark off the event, I request our chief guest, chairman and director to pay a floral tribute to Dr. Verghese Kurien. Over to the director for further proceedings.
Good evening, everyone. Distinguished speaker, the RBI Governor, Professor Raghuram Rajan, Chairman IRMA, and members of the governing body of IRMA, invited guests, friends, colleagues, and participants of the PRM and FPRM program, IRMA welcomes you to the third Dr. Verghese Kurien Memorial Lecture. I especially welcome Ms. Nirmala Kurien, daughter of Dr. Kurien, for kindly agreeing to join us on this day when we have gathered here to fondly remember our founder chairman, Dr. Verghese Kurien. Thank you so much for gracing the occasion. The great visionary Dr. Verghese Kurien left us on September 9th, 2012. To commemorate his memory, IRMA instituted the annual Dr. Verghese Kurien Memorial Lecture at IRMA to be held during his birth anniversary. The first such Dr. Verghese Kurien Memorial Lecture was delivered by Professor M.S. Swaminathan in November 2012. The second memorial lecture was delivered by Professor Vijay Shankar Vyas in December 2013. And at the third Dr. Verghese Kurien Memorial Lecture, we are honored to have the RBI Governor, Professor Raghuram Rajan, to deliver the lecture here today. It is a daunting task for me to speak about a legendary personality such as Dr. Verghese Kurien. I am particularly handicapped as I stand in front of an audience, many of whom have lived and worked with Dr. Kurien very closely and for many years. I have had no such luck and no such experience, and have met him exactly once after I took charge of this esteemed institution, IRMA, one of the last of the many institutions conceptualized and piloted by Dr. Verghese Kurien. Many tributes have been paid to Dr. Kurien. People from very diverse backgrounds from all over the country have contributed, reflecting the fact that Dr. Kurien was a truly national figure. A key source of aura around him was his unfaltering integrity. He was a man of conviction, and very clearly, once he had identified an issue and figured out a way to tackle it, nothing could stop him. He has been called the milkman of India. He was also a farmer's man, as most of his efforts were geared towards improving the lives and livelihoods of the Indian farmer. The Amul movement, the Amul brand, were his greatest contributions to India and to the Indian farmers, followed by the National Dairy Development Board, NDDB, to replicate the efforts and to mobilize farmers for milk production all over India. As an economist, I can say that this movement helped to increase milk production and make the country self-sufficient in milk and milk products. The variety of butter, cheese, ice cream, chocolates, sweets, cookies that our children get today from Amul was nowhere on the scene when many of us were children. Brand Amul has grown from strength to strength. The brand ambassador, the little Amul girl, has continued with her weekly comment on the current national and political events. The Amul girl is an institution in her own right, maintaining her neutral stand and views with a sense of humor during these politically turbulent years. Dr. Verghese Kurien was an institution builder, in today's language, a serial entrepreneur. Dr. Kurien visualized and built a series of institutions around the NDDB to support the dairy industry. Institute of Rural Management, Anand, IRMA, is among the youngest among those institutions. It was conceived originally during Operation Flood, during the 6th five-year plan, to produce professional managers for the cooperative sector. It is my pleasant duty to welcome the RBI Governor, Professor Raghuram Rajan. I am sure you are all eagerly waiting to hear what the Governor has to say to us today. We have received an overwhelming response to the announcement of this lecture by Professor Raghuram Rajan. In fact, we have, because of that, basically, organized for a live webcast of the lecture to enable our students who are away, most of them on field work, both the segments, both the years, and the alumni to participate in this event. We welcome PRM 34, PRM 35, and the alumni, our esteemed alumni, and all the viewers viewing this from afar. Now I invite the Chairman, IRMA, Shrideep Joshi, to introduce our eminent guest speaker and invite him to deliver the third Dr. Verghese Kurien Memorial Lecture.
Governor Raghuram Rajan, Director Jimal, my colleagues on the board, IRMA board, invited guests, IRMA faculty, and students. Namaskar. We are assembled here today to honor the memory of Dr. Verghese Kurien, a noble son of India, the founder of IRMA, and everything else you see around here, and in many parts of the country. Dr. Kurien spent his lifetime in the service of the Indian farmer. I was speaking with Nimalaji about was anybody in your family ever been a farmer? He said, no, we've always been, city people, service people. So here is a man who was educated to work in the urban corporate sector, chose to come to a distant place called Anand at that time, a Dust Bowl, and spend the rest of the life here working for the welfare of the Indian farmer. And in the process, he transformed the dairy industry, the Indian dairy industry, and I would say has left an indelible mark on the development scene. One often keeps hearing about, let's go to NEDP, let's look at the Amul model, the NEDP model. So in a way, he's not only left a mark on the dairy industry, but the entire rural development sector. And for my generation and future generations, he remains an idol, a great source of inspiration. I remember a conversation I had with him 25 years ago while reviewing the IRMA's first decade's work, and he said very emphatically, given our sunlight, given our resources, given our hard-working farmers, our farmers could feed the whole world. So those are the kind of ideas that he nurtured, he aspired for. I pay my respectful tribute to the legacy of Dr. Kurien. Ms. Nirmala Kurien is here, Dr. Kurien's daughter, on this August occasion. Thank you, Nirmala ji, for being with us. It is my privilege to introduce today the Governor of the Reserve Bank of India and a fellow, much more illustrious Sloan alumnus, Dr. Raghuram Rajan, who would deliver this year's Verghese Kurien Memorial Lecture. Dr. Rajan attended the Indian Institute of Technology, Delhi, the Indian Institute of Management at Ahmedabad, the Sloan School at MIT, where he got his PhD in finance. Dr. Rajan has taught at the Kellogg School of Business at Northwestern University, MIT Sloan School, the Stockholm School of Economics, and at the University of Chicago's Booth School of Business, where he was the Joseph Kidwitz Professor of Finance, and I understand continues to be on leave, Eric Gleischer Distinguished Service Professor of Finance. Dr. Rajan also served as Chief Economist at the International Monetary Fund for 3 years, chaired the Government of India Committee on Financial Sector Reforms, was Economic Advisor to the Prime Minister of India, and was Chief Economic Advisor to the Government of India before being appointed the Governor of the Reserve Bank of India in July 2013. Dr. Rajan has numerous publications. I, frankly speaking, don't understand much of finance, so I don't know which one to pick, so I didn't pick any. And he's got 2 landmark books, and of course, is a recipient of many prestigious awards in India and abroad. Without much ado, may I now invite Governor Raghuram Rajan to deliver this year's lecture.
Thank you very much for that introduction. Chairman IRMA, Shri Deep Joshi, Director, Professor Uni, Shri Nandakumar, Shri Sodhi, and of course, Ms. Nirmala Kurien. And also the students of PRM 34 and 35, if you're here or if you're listening in, other alumni and students, and friends from the press. Let me start by thanking the director of IRMA for inviting me to deliver this lecture. As all of you know, Dr. Kurien was a pioneer in the cooperative movement. He not only was instrumental in bringing about the White Revolution, but also he created a variety of institutions, including the one in which I'm speaking, as well as AMUL, IRMA, and so on. In creating the means by which farmers could get remunerative, stable incomes, even while professionals managed their interactions with the modern market economy, Dr. Kurien created a uniquely Indian model that has brought millions out of poverty. He was, as you've heard, a man of strong convictions, of determination, and of great integrity, and I would say that he truly is a giant of post-independence India. Dr. Kurien showed people the way to remunerative livelihoods, perhaps the best form of economic inclusion. I have little expertise on the technologies and the institutions he pioneered, so I will not opine on them. Instead, what I want to focus on today is another instrument for well-being, that is credit. And before I go further, let me tell you that the title for the talk today was a placeholder. If I've brought you here on false pretext, I apologize. What I want to speak about is not the state of the economy or the state of the financial sector, but the title of my talk today is Saving Credit. At a time when demand for bank credit in the country is weak, even while we will have enormous demand for it, if growth and investment pick up, we have to ask if India's system of credit is healthy. Unfortunately, I'm going to argue the answer is it is not. We need fundamental reforms, starting with a change in mindset. And a public lecture in memory of a great Indian who did much to change our mindsets is a perfect place to make the case. Let me start by just outlining the basics of a debt contract. The flow of credit relies on the sanctity of the debt contract. And the debt contract is one where a borrower, whether it's a small farmer or the promoter of a large petrochemical plant, raises money with a promise to repay interest and principal according to a specified schedule. If the borrower cannot meet his promise, he's in default. This, I guess, all of us understand. Now, in the standard debt contract, through the course of history and across the world, default means the borrower has to make substantial sacrifices, else he would have no incentive to repay. For instance, a defaulting banker in Barcelona in medieval times was given time to repay his debt, but meanwhile, he was put on a diet of bread and water. At the end of the period, if he could not repay, he was beheaded. Punishments became less harsh over time. If you defaulted in Victorian England, you only went to debtor's prison. Today, of course, the borrower typically only forfeits the assets that have been financed, and sometimes personal property too, if he is not protected by limited liability. This, of course, unless he has acted fraudulently. Now, you may ask, why such a harsh contract? And the answer is, the reason we have such a contract is because the lender agrees not to share in the profits that you make from your enterprise in return for not sharing the losses when you make losses. That is because he's not a full managing partner in their enterprise. And in return for being absolved from sharing in the losses when the enterprise does badly, to the extent that is possible, basically the borrower gets cheap financing. And the borrower gets the upside from the good times, which gives him the interest to manage the enterprise properly because he's going to benefit from the gains. So this is, in some substance, the standard debt contract. And when you have the standard debt contract, you can borrow from strangers who have no intimate knowledge of your enterprise or your management capabilities, because they're fully reassured that they can seize the hard collateral that's available if you default, while giving you all the upside when the firm or your enterprise is doing well. This is precisely why banks offer to finance your car or home loan today at just about 10%, 10.25 some banks, which is just a couple of percentage points above the policy rate. The reason you can do this is because the debt contract works well with small borrowers. The problem I want to focus on in this lecture is the sanctity of the debt contract has been continuously eroded in India in recent years, not by the small borrower, but by the large borrower. And this has to change if we are to get banks to finance the enormous infrastructure needs and industrial growth that this country aims to attain. The reality is too many large borrowers see the lender, which is typically a bank, as holding not a senior debt claim that overrides all other claims when the borrower gets into trouble, but a claim junior to his equity claim. In much of the globe, when a large borrower defaults, he is contrite and desperate to show that the lender should continue to trust him with the management of the enterprise. In India, too many large borrowers insist on their divine right to stay in control despite their unwillingness to put in new money. The firm and its many workers, as well as past bank loans, are the hostages in this game of chicken. The promoter threatens to run the enterprise into the ground unless the government, banks, and regulators make the concessions that are necessary to keep it alive. And if the enterprise regains health, the promoter retains all the upside, forgetting the help he got from the government or the banks, because after all, the banks should be happy that they got some of the money back. No wonder government ministries, I should say that again, no wonder government ministers worry about a country where we have many sick companies, but no sick promoters. Let me emphasize that I do not intend in any way to cast aspersions on the majority of Indian business people who treat creditors fairly. I also don't want to argue against risk-taking in business. If business does not take risks, we will not get architectural marvels like our new international airports, the developed for India low-cost business model in the telecom sector, or the world-class refineries that have been built near here. Risk-taking inevitably means the possibility of default. An economy where there's no default is an economy where promoters and banks are taking too little risk. What I'm warning about instead is the uneven sharing of risks and returns in enterprise against all contractual norms established the world over, where promoters have a class of super equity which retains all the upside in good times and takes very little of the downside in bad times, where creditors, typically public sector banks, hold junior debt and get none of the fat returns in good times while absorbing much of the losses in bad times. Now, why do we have this state of affairs? The most obvious reason is that the system protects the large borrower and his divine right to stay in control. This is not for want of laws. The debt recovery tribunals were set up under the Recovery of Debts Due to Banks and Financial Institutions, it's a very long acronym, RDDBFI Act of 1993, which was intended to help banks and financial institutions recover their dues speedily without being subject to the lengthy procedures of civil courts. In 2002, we got the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interests Act, which is the SARFAESI Act in short, which went a step further by enabling banks and some financial institutions to enforce their security interests and recover dues even without approaching the DRT. So we have the laws. Yet the amount that banks recover from defaulted debt is both meager as well as long delayed. The amount recovered from cases decided in 2013-14 under the DRTs was 30,590 crores. That may seem a lot, except when you realize the outstanding amounts that are being claimed from the DRTs is 2,36,000 crores. In other words, just about 10%. I should say that the recovery amount was about 13% of the total at stake. Worse, even though the law indicates that cases before the DRT should be disposed of in 6 months, only a fourth of the cases pending at the beginning of the year are disposed of during the year, suggesting that is, even if the courts focus only on the outstanding cases, that it'll take a 4-year wait before your case is disposed of. That is, assuming the tribunals focus only on the old cases. However, in 2013-14, the number of new cases were 150% of the cases that were disposed of. In other words, the number of cases is growing and the delays are growing even more, which means that the prospect of recovery is growing smaller and smaller. Now, why is this happening? You don't have to ascribe a great deal of conspiracy to this. The judgments of the DRTs can be appealed. There are 33 debt recovery tribunals, and each of these cases can be appealed further. They get appealed to a debt recovery appellate tribunal, and there are only 5 of those. So you can imagine 33 to 5, the backlog increases. But it's not just that. Even though Section 18 of the RDD-BFI Act is intended to prevent higher constitutional courts from intervening routinely in DRT and DRAT judgments, the Honorable Supreme Court recently lamented that, and I quote, "It's a matter of serious concern that despite the pronouncements of this court, the high courts continue to ignore the availability of statutory remedies under the Act and exercise jurisdiction under Article 226 for passing orders which have serious adverse impact on the right of banks and other financial institutions to recover their dues." In other words, it's not just the appellate tribunal where there's a backlog, it gets appealed further through the constitutional courts, the high courts, and delays go on and on. The consequence of the delays in obtaining judgments because of repeated protracted appeals implies that when recovery actually takes place, the enterprise has been stripped clean of value. The present value of what the bank can hope to recover is a pittance, as the numbers I quoted suggest. And of course, this then skews bargaining power towards the large borrower who can command the finest legal minds to work for him in repeated appeals, or who has the influence to obtain stays from local courts. So this large borrower can then hold the bank up and say, why don't you take a big hit on your loan or risk being held up in the courts for a long, long time? So faced with this asymmetry of power, banks are tempted to cave in and take the unfair deal the borrower offers. The bank's debt becomes junior debt, as I've described, and the promoter's equity becomes super equity. The promoter, in fact, enjoys riskless capitalism. Even in these days of very slow growth, I ask you, how many large promoters have lost their homes or have had to curb their lifestyles despite offering personal guarantees to lenders? The public believes that the large promoter makes merry because of sweet deals between him and the banker, and I've argued for a more mundane, but perhaps more disturbing explanation. Now, the reasons the public believes this is because of corruption is perhaps because of certain recent cases, but my sense is that it is Occam's razor that should give you a sense of what is the right explanation, which is basically the system renders the banker helpless vis-a-vis the large and influential promoter. Now, this is not to say that we should slow our efforts to bring better governance and more transparency to banking, but we also need to focus on reforming the system of credit. Now, you may ask, who pays for this one-way bet that large promoters enjoy? And clearly, it is you, the hard-working savers and taxpayers of this country. As just one measure, the total write-offs of loans made by the commercial banks in the last 5 years is rupees 1,61,000 crores, which is 1.27% of GDP. Now, of course, some of this amount will be recovered, but given the size of stressed assets in the system, there will be more write-offs to come. And to put these amounts in perspective, for many people, thousands of crores go way above your head. 1.27% of GDP would allow 1.5 million people to send their children to get a full university degree from a top private university in this country with all expenses paid. That's the size of the write-offs we're talking about. So, what are the economic consequences? Yes, there's a transfer, but should we be worried about it? What about the economic consequences? What happens as a result of this unfair sharing of losses? And the direct effect is to make credit costlier and less available. The promoter who misuses the system ensures that banks then charge a premium for business loans. The average interest rate on loans to the power sector today is 13.7%, even while the policy rate is 8%, and while loans to you for housing is 10%. So this difference between the interest rate that power producers pay and the policy rate of 5.7 percentage points, or between what they pay and what households pay of about 3 percentage points, is entirely due to credit risk. And this comes because the unscrupulous promoter hides amongst the scrupulous ones, and every businessman is tainted by the bad eggs in the basket. So it is obvious that if we focused on reforming this part of the credit system and made it much more equitable so that people who borrowed actually repaid when they could, you could bring down this risk premium, this 300 basis point risk premium, and it would have a large beneficial effect on the cost of finance which is so critical to the massive infrastructure needs that we have in this country. And perhaps when we're talking 300 basis points, this is far more than anything that monetary policy could do in the short run. A second consequence of our current system is that we focus not on ameliorating the system vis-à-vis the large borrowers, but making the law more draconian in order to force payment. And when we do that, for example, when we bring in the SARFAESI Act, which by the standards of most countries is very pro-creditor, the effect is that the large borrower finds a way around it through the system, while the full force of it impinges on the small borrower, who doesn't have the wherewithal to move the courts or to hire expensive lawyers. So the small entrepreneur's assets are repossessed quickly and sold, extinguishing many a promising business that could do with a little support from the bankers. So a draconian law does perhaps as much damage as a weak law, not just because it results in a loss of value on default, but also because it diminishes the incentive of promoters to take risk. And let me emphasize that. Think of a medieval businessman who knows he'll be imprisoned or even beheaded if he defaults. What incentive will he have to engage in innovative but risky business? And the answer is very little. And is it any wonder that business in medieval times was very conservative and you didn't get the kind of innovations of Steve Jobs that we have today? Indeed, a very thorough study by Viral Acharya of New York University and Krishnamurthy Subramanian of the Indian School of Business shows that innovation is lower in countries with much stricter credit rights. Or put differently, the solution to our current problems is not to make the laws even more draconian, but to see how we can get more equitable and efficiency-enhancing sharing of losses on default by going after the places where we need to make changes. A final consequence of the inequitable sharing of losses in distress is that it brings the whole free enterprise system into disrepute. When you have some business people enjoying a privileged existence, risking other people's money but never their own, the public and their representatives get angry. I have met numerous parliamentarians who are outraged at the current state of affairs. If the resolution of these kinds of issues are taken out of the realm of the commercial into the realm of the political, it will set back industrial growth. Therefore, reforms here are of utmost urgency. What we need really is a more balanced system, one that forces large borrowers to share more of the pain while being a little more friendly to small borrowers. The system should shut down businesses that have no hope of creating value while reviving and preserving those that can add value. And the system should preserve the priority of contracts, giving creditors a greater share and greater control when the enterprise is unable to pay, while requiring promoters to give up more at such times. So how do we achieve this better balance? And here I have a number of suggestions, starting first with better capital structures, that is, the financing in terms of how much debt and how much equity. The reason so many projects are in trouble today is because they were structured up front with too little equity. sometimes borrowed by the promoter from elsewhere. And some promoters find ways to take out the equity as soon as the project gets going, so there's really no cushion when bad times hit. Lenders have to insist on more real equity upfront and monitor the project closely to ensure that it stays in. Promoters, on their side, should not try and finance mega projects with tiny slivers of equity. We also need to encourage more institutional investors who have the wherewithal to monitor promoters to bring equity capital into projects. So that's the first suggestion. Second, banks need to react quickly and in a more concerted way to borrower distress. The longer the delay in dealing with a borrower's financial distress, the greater the loss in value to the enterprise. Some banks are more agile and have better lawyers, so the promoter continues servicing them while he turns around and defaults on other banks. In the absence of an efficient bankruptcy process that brings lenders together, the Reserve Bank of India has mandated the formation of a joint lending forum of lenders when the first signs of distress are perceived. And the idea here is the JLF is intended to find a way to deal with the enterprise quickly with options ranging from restructuring to liquidation, but it's a way of doing it quickly by pulling the lenders together and making it harder for the borrower to play off one lender versus the other. So this is something we've put in place. It's starting to work. Let us monitor its working and make the adjustments to make it work more efficiently. Third, the government plans to expand the number of DRTs and DRATs, and this is very timely. It will also be most effective if accompanied by an expansion in facilities, trained personnel, and electronic filing of and tracking of cases as suggested by the Supreme Court. Also, it's worthwhile contemplating whether we can bring in some monetary incentives to tribunals for bringing down the average duration of cases. If we can do this without compromising on due process, it deserves to be contemplated. We could also impose some limit on the number of stays each party can ask for at the beginning of the whole case. We should insist that appeals to debt recovery appellate tribunals should not be a matter of course. It shouldn't be that every case, no matter how trivial the issue, is appealed once more. Indeed, debt recovery appellate tribunals should require borrower appellants to deposit a portion of the money ordered to be paid by the DRT, as has indeed been laid down in the law, but this is an issue which is waived again and again by the DRATs. That should not be the case. It's also worth examining if we should go to a system where appellants should be made to pay the real cost of delay out of their own pockets if they're unsuccessful, where the real cost of delay includes the interest costs of postponed debt payments. Turning to other suggestions, we should go by the suggestion of the Supreme Court, and high courts, for example, should respect the spirit of the laws and entertain fewer appeals. They should not intervene as a matter of course again. It is hard to see what points of law or judicial administration are raised by the standard commercial case, and routine judicial intervention typically favors the recalcitrant rich borrower at the expense of the lender. Now, we could also think of ways that we could bring some flexibility to the banks themselves in terms of restructuring these cases in order to give a better benefit to the banks going forward. We have a number of cases which are in distress in the financial system, and what we have to do is find ways to deal with these cases. Now, typically, what the banks want us to do is to display forbearance. Now, what does forbearance mean? Basically, pretend the loan is still paying, shut your eyes to the fact that it's become non-performing, and allow us to essentially roll the loans over time. Now, if you look at the history of every financial crisis, you see that the best way to deal with financial sector problems is to recognize the problems early, deal with them, and then move on. The longer you postpone, the longer you delay, the longer you extend and pretend, the worse the problem becomes. Problems don't disappear. Burying your head in the sand, ostrich-like, only ensures the problem becomes more dangerous. So again and again, I think when you read the history of periods of financial stress across the world, the solution seems to be get your act together, recognize the problem, deal with it effectively. Don't push it into the future. Don't extend and pretend. This is why the Reserve Bank of India is extremely wary about extending forbearance. Regulatory forbearance is basically saying this loan, which by most normal standards is non-performing, for the sake of regulatory purposes and for provisioning, is performing. And that is an issue that many people want us to, that is something that many people want us to do. It is something that is problematic. Now, I want to distinguish forbearance from flexibility. Now, banks have also been asking for flexibility. That is, we structured these loans badly. We made them overly short maturity. We are talking about 30-year projects. We want the project to pay in 7 or 8 years. That is too short. We should be allowed to extend the loan longer so that the time period for repayment is extended, matching the cash flows that are being produced. That was a mistake we made in the past. We should be allowed to rectify that mistake. That's one set of demands from the banks. Another set of demands is, look, these borrowers simply cannot repay at this time. They don't have the cash flows to repay, but they may be able to repay in the future. Let us now take some equity. In the downside, we will write down some debt, but in return, we'll take some equity. So when the project does better, we can actually get a lot more of the upside. I think I want to distinguish forbearance, which is the first thing, pretend the problem is not there, from flexibility, which is we're going to deal with the problem, give us the tools to deal with the problem. When we look at flexibility, the Reserve Bank of India is far more open to ideas where we can expand the flexibility of banks to deal with the kind of situation we are in today and focus on trying to retrieve the kinds of assets that have got into trouble with appropriate flexibility. So let me come to the conclusion of what I want to say here. We have a whole bunch of suggestions on what we can do to rectify the situation where we have a one-way allocation of risk in the financial system, especially for large borrowers. We also have to deal with a current situation where, for whatever reason, a lot of large projects are in trouble. We have to find ways to get out of this trouble, to refloat these projects, to refloat these assets which are critical for the country. We have to do it in as reasonable a way as possible, a way that will be fair, that will be seen as fair by the public. And what the Reserve Bank of India is trying to do today is trying to help that case. But going forward, we need to make reforms in the financial system so that we don't have this one-way bet where somebody basically takes no risk but gets all the returns, while somebody else takes all the risk but gets very little of the returns. We need a more equitable sharing of the returns. It's necessary not just for fairness reasons, it's necessary, as I've argued, for economic reasons, but finally, and perhaps most important, it's necessary for political reasons. If we don't have a fair sharing of returns and risks, the whole system of borrowing will come into disrepute, and you will not have public support for the kind of lending that banks desperately need to do if we need to get to the high levels of growth that we have contemplated for the future. So let me end by saying, when you see this kind of system, you see the willingness perhaps, of the system to tolerate the kind of behavior we've seen. You have to ask, why does this also happen? Now, I'm an economist, I'm not a sociologist or a philosopher, but I will guess that perhaps the reason we've been so willing to protect the borrower against the creditor is that the hated moneylender looms large in our collective psyche. So we have in mind all those movies we saw about the moneylender, squeezing every last ounce of blood out of you. But we must remember the large borrower today is not a helpless, illiterate peasant. And the lender today is typically not the sahukar, but the public sector bank. In other words, we are the lender. When the large promoter defaults willfully or does not cooperate in repayments to the public sector bank, he robs each one of us citizens, even while making it costlier to fund the new investment that our economy needs. Let me emphasize, the solution is not more draconian laws, which the large borrower may well circumvent, but which may entrap the small borrower. What we need is a more timely and fair application of current laws, which means we need to make the judicial system work more efficiently in making this happen. We also need new institutions, such as bankruptcy courts. I must emphasize that the government is contemplating a new bankruptcy law, which is very much needed. And we need other kinds of agents, such as turnaround agents. One of the most effective ways of dealing with distress in industrial countries is bringing new management. And there are firms, private equity firms, entities like our asset reconstruction companies, which move in, take over management of a failing institution, and set it right. We need more such institutions in this country. The ability to take out promoters who are not able to revive the firm and replace them by new management which can undertake the task of revival in its own right. So again, one can make suggestions about how to make the asset reconstruction companies more effective. Thus far, they have basically not been as effective as the promise was initially. Again, there are a number of measures one could think of to make them work in a better way. I think with these kinds of changes in institutions, as well as changes in the way the legal process operates, we could get a much more effective system of credit, and a system of credit which will be cheaper. And cheaper credit is what we need as we go forward into the enormous investments that the country needs. Finally, I think, and this is what I started with, we do need a change in mindset, where the willful or non-cooperative defaulter is not lionized as a captain of industry, but justly chastised as a freeloader on the hard-working people of this country. And I'm sure that that change in mindset is one that Dr. Verghese Kurien would have approved of. Thank you very much.